question. We also have some people on the conference call, so we won't do a follow-up in the first round. If we have time, we'll come back for a second question. We are webcasting this press conference, so please use the wireless microphone, which my colleague will bring to you. They're standing on either side of the room and at the back. And then we will take questions in the room first and then turn to the phone lines to make sure everyone gets a chance to ask their questions. Governor Poloz will be happy to answer questions in both official languages. And let's get started. Gloria.
I'm wondering, here we go. Would the Bank of Canada consider at some point expanding a balance sheet expansion?
So large-scale asset purchases are part of our toolkit, as they are for other central banks. We've been fortunate to not need anything like that. We've not used anything like that, but it's available to us. And as I indicated in the room, there's a whole range of tools that normally would only be contemplated if interest rates lose their ability to address the issues that we face.
Next question is Kim.
Kim McCrail from the Wall Street Journal. Governor, could you walk us through how you anticipate the interest rate cut yesterday will impact Canadian housing markets and what that might mean for vulnerabilities?
Sure. So, I mean, look, there's no question that over the next few months we'd expect to see shock minus control, if I can use that kind of layout, more housing activity than we see without the interest rate cut. However, as I argued in the presentation, we believe the most likely course of this shock is to cause consumers to be concerned, to perhaps reduce their major purchases, to be more cautious in their behavior. That would be the sort of thing we would predict, although it's not a given. It's just, it seems like to us, an important downside risk to get in front of so that we can cushion the blow as it emerges, as opposed to waiting until it happens and then responding. And so as we see it, there's an unquantifiable effect from such a shock on confidence, and then from there, a difficult to quantify effect from confidence to housing purchases. But this is one of the best relationships in economics. Consumer confidence is a very important variable in economist models for things like vehicle sales, vacations, housing purchases. Okay? Consumer confidence matters a lot. It's not just, am I confident or not? It's about your long-term sense of your job security, your income security. Those things matter to a lifetime decision such as buying a home. And so it feeds directly in. And so my expectation is that we'll see consumer confidence declining as this unfolds, and that our hope is that lower interest rates will in some way mitigate that decline. If we were lucky, it would offset it completely, just to buffer the whole thing and stabilize the housing market. But at this time, it's only in perspective. I can't really make those claims yet.
Fergal and then David.
Fergal Smith, Reuters. Governor, was the bank leaning toward a cut even without the outbreak of the coronavirus? You mentioned a number of other issues that were impacting the economy in the first quarter.
Yes, no question. As we indicated, both in October, December, and January, we had a number of downside risks that we were monitoring, and we thought that net there were downside risks to the outlook, but we believed that they were, on balance, sufficiently small that they were being outweighed by the risk of adding to financial vulnerabilities if we did act. That's a complex trade-off. I'm not going to pretend that we measure those trade-offs to the decimal point, but they are quantifiable trade-offs, and we've got new modeling to support that analysis. So, but what has happened is over the last few weeks, that downside risk has accumulated. and taken us into a zone where we believe those risks are sufficiently negative, they outweigh that other concern. So yes, the virus, that's before mentioning the virus. But you could arguably say that oil prices and other commodity prices are down quite a bit since the first of the year, and that's due to the virus. But so of course, it's something you don't necessarily react to until it occurs, because you wouldn't have necessarily forecast that. So just in the shocks that I outlined, the special factors, it suggests that we will have 2 quarters in a row, Q4 and Q1, of very slow growth, and often that is sufficient to put a dent in consumer confidence for a more prolonged period. And so for all those reasons, we believed we had a bias towards moving before bringing the virus analysis into the consideration. That, of course, that is, of course, the big one, but at this moment, not really quantifiable except in the terms of the disruptions that would cause. But we believe it would also affect consumer confidence and have a more profound effect.
I can go from here.
David?
Dave Parkinson of the Globe and Mail. Governor, can you give us an idea? I mean, you've talked about this being a coordinated move with the other G7, both fiscal and monetary policymakers. Can you give us a better idea of just to what degree there is agreement on the actions that will be taken? Obviously, we saw the Fed cut 50 basis points. The next day, we see the Banque du Canada cut 50 basis points. There are other central banks out there that are presumably moving towards something, but I'm just trying to get an idea of what level are we coordinated. This is not every central bank putting out a statement saying we are all cutting today, obviously, but to what degree are we going to see the other central banks and then the fiscal authorities also make a move here?
So I mean, obviously I can't speak for other central banks or for even our own fiscal authority or other fiscal authorities. There's a lot of counterparties that I can't actually discuss. But I think the better way to think of your question is, what does policy coordination look like? If you define coordination as everybody acting on exactly the same day in exactly the same way, such as occurred in 2008, Thanksgiving weekend, Canadian Thanksgiving weekend, that is not a situation we find ourselves in today. But what we do have is a very frequent, high-level collaboration, which I think is as good as coordination actually gets in most situations. It is that we have talked enough that we have a shared understanding of what we're facing. We're in broad agreement about which tools would work and in what situations. When we talk about central banks, some central banks have more room to maneuver than others, so that, of course, is a constraint that enters that notion that you're laying out. Some fiscal authorities have more room to maneuver than others, so there are constraints. And so it's not a simple thing like in a textbook where everybody agrees and hangs up the phone and does all the same thing. So I just think that you need to back off on the definition of coordination, and let me assure you that the level of coordination is as high as I've experienced in my time as governor. It's highest I've seen.
All right, we're going to Damien over here on the far right, at the back, and then followed by Jeff.
Hello, Governor. Damien Lynch of MT Newswires. Can you say, were you more likely to go 25 basis points until the Fed went the full 50 basis points a day before? And also, can you provide a little bit of colour as to, there was the talk in the market started last Friday afternoon that there may be, that the Fed might actually move on Sunday night by the 50 basis points. Can you give some colour as to the meetings or the talks that you and some of the other council members had, say, from last Friday afternoon to your own decision yesterday?
Well, to most of your questions, I would just say, no, I can't, or I won't. So But what I will say is that we were in the middle of our process, our usual process, starting last Thursday. And, we went through Thursday, Friday. We got a lot of news about the virus over the weekend. We were, as I've just described, we had more than enough reasons to adjust our policy without even bringing the virus into the deliberations. And so it was at that stage that we began to discuss what we were moving, and it was a question about what was the magnitude. And as I discussed in my talk, there's a strong sense that in an uncertain world, which we've all been working in, we call it risk management. It's not a simple mechanical targeting process. Of course, when retail sales are weaker than we expected, during the fourth quarter, a technician might say, oh, consumption is less than you thought, therefore you must get ready to tweak your interest rate downwards. That is not the way we think of it. What we think of it is there's a zone within which all sorts of variability happens in the data, and in that zone, small shocks, they just happen and we see through them. That's because it's not a precise business. It's a risky business. And so you're trading off one risk versus another, which I went to some length on. As we moved into the last few weeks, then those downside risks began to accumulate, and that pushed us outside the normal bounds of tolerance around our policy setting. And as I said, that was sufficient to make us want to move interest rates lower in response to that, and to do so in a decisive manner. That is not to, because some of the effects that we expect to see are prospective, we think it's important, if possible, to get out in front so that we put the cushion in place before the economy begins to feel the confidence effects related to the virus. It is not unlike what we did in early 2015, where it was clear that oil prices were falling dramatically. The arithmetic around investment was clear. We spoke to all the companies. They told us how much they were going to cut spending. And so we knew how big the shock would be long before it showed up. And that's a big advantage. So we were able to get in front of it. And I think that sped up the economy's adjustment to the process. So we're hopeful again that by being clear and decisive and actually moving in a significant way, that we get a behavioral response that cushions the economy before the real part of the crisis of the coronavirus effect arrives. So I think that's as far as I need to go. We certainly converged on the 50 basis points through the thought process I've just described. The fact that the Fed went in the middle of that discussion, of course, we acknowledge that, and I'm not saying though that it didn't matter. It mattered to us, of course. And I should add that we all believe as policymakers that when you have policy making, if it's a global shock, when it's coordinated, you get an outsized reaction, okay? Because it's more confidence inspiring when other entities are doing the same thing. So it gives people more confidence that you're meeting that shock head on. And so there's, in effect, a coordination premium that you get by acting in concert. And so to us, that was also a positive benefit to the fact that the Fed went on Tuesday and we knew we were going the very next day.
Jeff is next, followed by Tara.
Hi, Governor. In the part of your speech where you talked about lower interest rates and the housing market too, you mentioned that you expect the B20 mortgage guideline to keep the stock of mortgage debt, to keep improving the quality of that.
That's correct.
So, what do you expect then the effect of the plan by the federal government and by OSFI to tweak, the minimum qualifying rate by moving away from your benchmark? What effect do you think that's going to have on the housing market?
Well, I think that it's a desirable change because it makes the stress test much more sensitive to the actual movements in interest rates. By the way, that benchmark rate used to move around more. It seemed to stop moving when we decided to use it as an anchor to the stress test. It seemed to be less sensitive, let's say, to interest rate movements. And so I think we always believed it would move around, so that if interest rates were going up, then of course the stress test would go up. You still get your 200 basis points of cushion, but when they went down, it would go down. And that hasn't been the case in the last number of months. So it's a more market-sensitive anchor now to the stress test. The stress test is still 200 basis points, so it's simple to remember. I got to qualify for a rate that's 200 basis points higher than I'm paying, and that means I've got room to maneuver in my balance sheet, in my income, in order to absorb a higher interest rate if that happens. So that's what we intended the thing to do. And the fact that at that very moment in time, and at the time that all the articles were being written, it meant that the stress test would be slightly easier is quite irrelevant to that analysis. There is no question that I would have to say mechanically, the qualifying rate, if nothing was happening right now, the qualifying rate would be going down a little wee bit as we switch from one anchor to the other in April. But now what's happening, of course, is actual rates are lower anyway. And so the main thing that's been preserved is that people are qualifying for a mortgage at 200 basis points above what they're paying. So we know they've got a buffer in their finances. And that means that every new mortgage that is being approved under that arrangement is contributes to financial stability. It's more sustainable than all the mortgages that were being granted before. Now, we've always had good underwriting, so don't make it sound like suddenly we got good underwriting. So our banks have always been very, let's say, careful underwriters of mortgage debt. But the fact is, that gives us additional comfort. And so when we talk about how debt may go up because interest rates are lower, we say yes, but at least now if debt is going up, it's going up with higher quality debt than what we had in the existing stock of debt. So that's good reassurance to the central bank, which is trying to take account of these competing trade-offs. And so it's a very welcome change.
Tara and then Gloria.
If COVID-19 turns out to be a short-term issue, how quickly will the central bank look to reverse this rate and reverse this cut and raise rates?
Well, I don't know if I want to front-load that. I mean, you know what our operating framework is. It'll depend on what the forecast for inflation is, what the economy is doing at the time, and so I simply won't front-run that. If we do our forecast in detail every 3 months, so we're working on it now for April. That update will contain obviously some judgments around the effects of the coronavirus, but it's a very fluid situation. So principles of risk management again are going to be like, well, we have to wait and see, how things unfold. And we've got to watch and see if we're right about our assumptions. And if we're wrong, then we revise that and we'll make a plan around that. So we haven't changed our operating environment. The framework is the same as it always was. So if there's no fallout or the less fallout than we're allowing for, that'll of course be unambiguously good news for everybody.
Yeah, I think I'm supposed to go to Esteban next.
Okay.
Governor, you said that you are ready to move again if required. What will you be looking at over the next 6 weeks in terms of data as a proxy of where the economy is?
Well, there's nothing unusual in that sense. We'll look at all the same data that we always look at. We just got the national accounts for Q4 last week, and so we've got that strong starting point of data to work from. It had, as I said in my talk, some weaknesses in it that we're watching carefully. We want to see if those weaknesses continue to get bigger or if we get signs that they're reversing. So that's on investment. So for instance, if NAFTA, I expect any time now, CUSMA, the new NAFTA, would get ratified. That, I think, would be confidence-inspiring for the business sector. We have businesses will be watching how the virus unfolds and how it may affect their environment. So that could delay things. We simply don't know. So we're watching all of those things together in the usual way. And in April, we'll have a new forecast for you, and it'll be no doubt highly conditioned on some of these assumptions. And then we have to monitor how those assumptions play out over the coming weeks. So right now, we're very focused on how the virus may be spreading and how it may be affecting business, and for that matter, the people who work in the businesses. So, you know, we see, you know, we have, in Italy, we have a clear case study going on that we're all learning from, and we're part of the coordination we talked about earlier, is that we're getting very straightforward, person-to-person discussions about what they're seeing. 2,700 cases, around 10% require intensive care. You know, we've got rates of people who succumb to the virus, and what their age is. So we get a lot of data from countries that are out in front of this shock. And so I'm sure that'll be very helpful to our own health authorities. And so all that is it's impossible simply to predict. So for now, it's we've set things up so we think we've cushioned whatever blow is coming, and we'll monitor things, and that's data dependence. That's the way it looks.
Okay, I think we're going to go to the phone line now. I believe there's one question. I just want to remind people on the call to mute their line if they're not asking a question. You can do that by pressing *6 and unmute by pressing *7. Do we have a question from the phone?
Hi. Hello?
Hi, Greg, we can hear you.
We can hear you.
Hi, Greg Quinn with Market News. Governor, you've spoken about bringing the economy home. Over your term, how much of the problem with getting home has been a series of different headwinds like COVID-19, and how much is underlying structural issues in the Canadian economy?
So, you know, my sense of home is that we've been in the neighborhood of home for about 2 years now, with inflation on target, unemployment at 40-year lows, and wages gradually catching the upwave. It's been very encouraging to see. And through that period, as you know, interest rates have stayed constant. The Canadian dollar has stayed quite steady. And so it's been a highly predictable environment for business and for job creation. So that's been gratifying to see. And in that context, as I said, of course, we saw shocks along the way. I would think of them primarily as kind of like it's springtime, so I can use the pothole analogy. Certainly in Ottawa, we got that. And so, you know, when you see the little potholes, you just kind of drive over them and you feel it, you think, okay, that wasn't too bad, and you just stay the course. But then what happens is something big you can see. There's, you know, one of those big puddles that you don't know if there's a hole in the bottom of it. I promise you it's a good idea to drive around those things, because there often is a hole in the bottom of those big puddles. And so it becomes a detour, right? And so it's clear to me that we have the makings of a new detour here. We have the ingredients. And so we've had to say, well, we're going to take, for one thing, the economy is quite resilient. It's demonstrated that, and I spent a lot of time on that today. That's a good thing. Think of it as, you know, where do you want to be when something like this happens? Well, if you're at home, okay, you're more resilient if you're already at home. And the economy is at home, and so it's in a resilient place to be able to adjust and to absorb a shock when it comes along. And so here we are. But it is requiring us in policy space to take a bit of a detour. And so it'll be our job to do everything that's in our control, to use our tools to get the economy back on track, to get back home as quickly as possible. We are dealing with an unknown size and unknown scope of shock, and so we're taking as precautionary measures at this stage. So that's about how I can sum it up for you, Greg.
Okay, so there are no more questions on the phone, so we're back in the room, and I've got Gloria. We have a bit of time, so maybe 2 or 3 questions.
Okay.
So, Gloria Galloway, Mace News. So, you touched on this a little bit earlier, but I'd just like to get a bit more specific. You said a couple times that you're ready to adjust the monetary policy further, if required, as a result of this evolving situation. What will you be looking for in terms of the virus specifically, in terms of North America, Canada? What are you actually going to be looking for before you make decisions about what you're going to do, next steps?
Well, as I indicated before, we made a decision this week not to dip our toe in the water, but rather to make a decisive and clear move so that people get immediate impact through mortgage renewals and cash flow for those with flexible mortgages. And so we believe we've done a lot there to cushion a blow. We don't know how big the blow might be, so we'll be looking at ways to figure out how big that blow might be and how long it might last. So, as I said, look, if production is going to be disrupted, if people need to stay home from work with their children, monetary policy has no means of addressing those things. It's what economists call supply shocks. You saw the question in the room. Of course, that's absolutely true. But what we can do is put a little bit of a safety net in underneath that, so people can say, well, the good news is my mortgage payments are going to be $100 less per month or whatever, so I've got a little extra cash flexibility than I didn't expect. And so you've put something in there. But really, what the coordination discussion is going towards is what sort of targeted measures can be taken to protect those of us who are the most vulnerable, people who do get sick and then are at home for 2 weeks or in hospital for 2 weeks or whatever, or those who have to be home because their kids are going to be not in school. So in Japan, they've got closed the schools. Some people have to stay home. So companies are taking actions in concert with the government to kind of cushion that blow for the most vulnerable people. So those kinds of measures have to be, formulated and thought about and so on. And of course, that would be something you'd want to take into account about whether one needs to do anything more or if it's of purpose to do something more in monetary space. So there will be an intense coordination that crosses those policy spaces. And so the government has formed a special committee to take a whole of Canada approach to this. So let's watch and see how that goes. I'm certainly not in a position to predict those things. I'm just here to say, and from our part, this is one thing we can do to contribute to that offset. And so there you go. Now let's see how things unfold from here.
All right, so this is the last question. David?
Governor, I know that we're still 6 weeks away from having formal new forecasts, but
Right.
you did indicate that your analysis at this point is that we had a weak fourth quarter, we will have another weak first quarter, and that there will be an impact spilling over to the second quarter. I'm wondering if you can, without specifically quantifying, if you can give us an idea of, do you believe now that the first quarter will be slower than the fourth? Do you believe that the second quarter will be slower than the first?
Yeah, I'm really not it wouldn't be fair to the experts, our staff, who spend all day trying to do the best job possible for you, Dave, in order to come up with that. But as I said, I can go so far as to say, we know Q4 was less than 1% growth, even after you add back in things for some of the special factors that I mentioned that would not be repeated. You've got the shutdown in Oshawa. Once it's shut down, it's shut down, so it doesn't get shut down again. You got the CN strike. et cetera. So you got some of those special factors that you can sort of frame up estimates that you say, well, if that hadn't happened, or if the weather had been normal and the crops didn't get left in the field and then they didn't get shipped because of the rail strike. So you kind of try to do back the envelope calculations and those things. You would boost growth in the fourth quarter a little bit, right, above what was reported. And so another thing was we thought consumption would be slower. Why did we think that? Well, because retail sales were slow. But I'd said in a couple of fora where I think you were present, our retail sales are not the same as retail purchases in our data set. Retail sales are Canadian stores, what they're selling. Retail purchases would include things you're buying from, let's say, Amazon, which is reported, not actually reported in that way. Amazon doesn't break down Canada, the United States, and Mexico. It's one thing. So StatsCan has to do a lot of reconciliation of data in order to come up with it. And sure enough, consumption was stronger than the core indicators suggested it would be, which is great to see. It kind of cements that resiliency point I've been making. That's a lot of complexity for me to try to figure out what's Q1 going to look like. All I'm suggesting is it looks likely to us that it's going to be another slow quarter. So it's not like the quick rebound from a depressed Q4 doesn't seem likely, given the things that we can see. So let's leave it at that for today. As for Q2, I have no insight into that except to say if the virus affects consumer confidence, it's already March. So consumers then would presumably reduce their spending or slow their spending after March. So that's getting into Q2. And so for all those reasons, I'm thinking the track for output is going to be less than we gave you in January. And sufficiently so, as that's why we made this move this week. But let's, sufficiently so is not the same as giving you new numbers. I'm not in a position to do that.
Thank you, Governor. That concludes the press conference. Thanks, everyone, for coming.
Thanks, everybody.